If the Modigliani-Miller theorem, without taxes, tells us that capital structure doesn't matter, the trade-off theory explains why, in the real world, it actually does. The trade-off theory suggests that a firm chooses how much debt and equity to use by balancing a carrot and a stick. It essentially argues that there is a sweet spot where the value of the firm is maximized. 1. The carrot, the interest tax shield. In the real world, governments allow companies to deduct interest payments from their taxable income. Dividends paid to shareholders, however, are not deductible. The intuition: debt comes with a discount from the government. For every dollar you pay in interest, you pay less in taxes. This effectively leaves more cash in the pie for investors. The result: this incentive pushes companies to take on more debt to increase their total value. 2. The stick: costs of financial distress. If debt is so great because of tax breaks, why doesn't every company fund itself with 99% debt? Because of the stick, the risk of going bust. Direct costs: if a company gets too close to bankruptcy, it has to pay massive legal fees, court costs, and liquidator salaries. Indirect costs: this is the hidden damage. When a company is struggling with too much debt, customers stop buying, fear of no future supports warranty. Employees leave for more stable jobs. Suppliers demand cash upfront. The intuition: as you add more debt, the probability of these bad things happening increases. Eventually, the fear of these costs starts to outweigh the tax savings. 3. Finding the sweet spot. The trade-off theory is a balancing act that can be expressed as a simple mental formula, where VL is the value of the levered firm with debt, V_U is the value of the unlevered firm, all equity. PV stands for present value. The path to the optimum: 1. Low debt. Adding debt is purely beneficial because the tax savings are high and the risk of bankruptcy is almost zero. Firm value goes up. 2. Moderate debt. Tax benefits are still coming in, but the smell of financial distress starts to appear. The value still grows, but more slowly. 3. The peak, optimal point. This is the exact moment where the benefit of the next dollar of debt is perfectly cancelled out by the increased risk of bankruptcy. 4. High debt. Adding more debt now is toxic. The cost of potential bankruptcy grows faster than the tax benefits. Firm value starts to drop. Summary: different strokes for different folks. Because of this trade-off, different industries have different optimal structures. Utility companies have stable cash flows and low bankruptcy risk, so they trade off toward high debt. Tech startups have volatile earnings and high risk, so they trade off toward low debt, mostly equity, to avoid early bankruptcy.